Hey folks, welcome to Market Technical Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. For today, Friday, March 14th, we have quite a day to discuss, and we're going to get pretty much right into it because it's just the volatility today. Those of us that are traders intraday, it's just so active all day, and the swings are just so intense that it's really exhausting, frankly. It's not only me doing the chat room and discussing the intraday movements of the markets and trades and so forth, but just the constant movement. Today we had a day where the markets got hammered. Let's be honest. Let's call a spade here. The markets got hammered. We had some craziness this morning, and I'm going to get into it as we talk about the intraday chart. So let's take a look at the intraday. Now, this morning, the futures are kind of hovering on the downside. You have the futures lagging about 12 to 10 to 8 points down, and this is the S&P future, the E-mini contract, the M contract now. So I really want to focus in on that. So anyways, we have the M contract, and we're discussing the intraday 10-minute. And what you really saw this morning was the futures trading down. There was no kidding about that, no surprise to that picture of the markets. And then you had the CPI number at 8:30 in the morning. And the CPI number came in actually better than expected. And we always talk about how even though the numbers are going to be bad, it's whatever the market expects. The market always has a prejudged level, and that can move up and down throughout the course of the month or the week or whatever. And ultimately, if it comes in better than the market's anticipating, then the market jumps, or the market jumps on that news. And if it comes in worse, then the market takes a hit. Well, the CPI came in better, and you see the spike up here. So you see a massive spike up in the futures to the point where the futures were trading up 12 points. And again, we're talking S&P points here. So this isn't NASDAQ or Dow points. This is S&P points. This is a huge move. You can see the magnitude of this move here. And then you start trading in this sideways pattern. And we always talk about that being a bull pattern, where you get a couple pause candles before another move up. And we always like to play that pattern, and sure enough, it took another move up. But it coincided with some Bear Stearns news, and this is where things got really tricky. All right, really tricky. Because Bear Stearns basically came out and said JP Morgan was going to supply them with cash, basically give them all the cash they needed because they were having trouble with liquidity issues. And basically the New York Fed was involved in this deal too. Now, the New York Fed was backing the deal or whatever. JP Morgan was giving them money, and everyone thought this was amazing. This is a virtual bailout. Everyone said, yeah, this is phenomenal. And you see the futures actually jump to up 20 points on the S&P futures, all the way up here. And then all of a sudden people start to look into the news and see that the Fed basically says, JP Morgan, you guys put up the money, you guys don't even have to take any risk. We just want you to put up the money. We're going to take the risk. This is, and all of a sudden the market started to get very, very scared here, because virtually if JP Morgan has no risk in it, it means things are really bad. It means that they don't expect a lot from Bear Stearns, ultimately possibly a bankruptcy issue or something like that, and the market all of a sudden started to panic. And look at the fall that ensued. This is probably one of the largest falls I've seen in years in a consecutive move, and on Bear Stearns. And the volatility today and the movement in the S&P futures and in the markets overall was probably the most volatile day I've seen in 5 years. No kidding aside, guys. It was that crazy. And anyways, the market started to dump out. And you basically went from 1336 up here on the SPY, on the S&P minis here, the ES minis, the S&P futures, to all the way down to basically 1279, which is the low. That's a 40-point reversal in a matter of minutes. And we're talking S&P. If we said 40 points on the NASDAQ, well, it's still big, but it's not that crazy. Or 40 points on the Dow, that's really nothing. But this is S&P minis points. This is huge. You basically saw the NASDAQ futures being up 30 points and ultimately being down as much as 60 points, 50 to 60 points here. An 80-point reversal from this point to this point. Ultimately, we always talk about oversold bounces and panic really came in here, and you saw the bounce back effect. Now, what basically you saw here was a channel. No doubt about the channel formation right here. Ultimately, you saw a breakdown. Once you broke below this channel, folks, you knew you were going to get a double bottom. All right, it's just automatic. You almost always get it. You got the dip, and then you got the retest of that lower end of the channel right here, which is the 20 moving average, and then a sell to a double bottom. And notice how they always take out the lows on that double bottom. They always want to take it below because it gets more shorts to jump on board. Ultimately, all of a sudden, late in the afternoon, and this was about 2:30 in the afternoon, we saw a massive rally. So what they did was basically freak everyone out, thinking, okay, they just broke the double bottom here. This is going much, much lower. And it looked like that. Let's be fair. Let's call a spade again. And it looked like that, but you have to know what the market does. And the put-call ratio was approaching 1.5 again down here. Way too high. You know there's way too many shorts in it, and you know you're going to get short covering coming into the Friday close. Now, a lot of people don't want to hold any of these stocks over the weekend because, let's be honest, the Asia is going to be ugly on Sunday night into Monday. Asia is going to take a hit unless we get some positive news. Now, that's not out of the woods yet. You guys know we've constantly been expecting news out here, and nothing's changed, believe it or not. You still have to be on alert. You got the Fed next Tuesday. You got Goldman Sachs reporting earnings next week along with multiple other financial institutions. And you also have Options X. And what do we know about Options X? It's going to be a wild whipsaw week, ultimately going probably the opposite way than the majority of players out there. So if you got too many bears, it's probably going to push up as the large money wants to take it away from those put holders, and vice versa. If there's too many calls out there in that market, they'll probably push it the opposite way. So you got quad witching on Thursday this coming week because Friday's closed. Friday's Good Friday, and the markets will be closed. Anyways, we saw a massive spike here. This is a huge rally in the afternoon, basically cutting the losses in half in the market. Then we got the little pullback. You always like to see that pullback before another push up, and you got to push right into the close. So it was a very interesting market, and one that was probably, as I mentioned, the most volatile intraday market I've seen in 5 years. It was unbelievable, guys. Just not a lot to say aside from that. The market, just the volatility involved in this market was just out of this world. And you can look on the SPY intraday. I mean, there were some great shorting opportunities. Notice this shorting. This is one of my favorite shorts into the afternoon here, where we got that massive rally, and we came into a basic necktie. It's not quite a necktie because they're not the two moving averages, the 20, the 50, and the 200 aren't meeting there, but virtually a necktie here. And once you hit that upper level, you knew you'd push through the 50 because they always push it through a little bit, but the chances of it getting through the 200 were very remote, and you could get a good short off there, and you got a basic drop, and you knew it was going right back to that 20 before bouncing. So you got a nice bounce off that semi-necktie or that in spirit of necktie, right back to that 20 moving average, and a bounce right off there. So the short really is right there to there. You're going with the market, a weak market, obviously, even though it's a massive bounce, and so forth. Now, let's be honest, as we talked about this, we at InTheMoneyStocks.com, you know, we could have seen a pullback today going into next week when we got the Fed and stuff, but this was a sizable pullback, folks. I mean, we're not going to BS you guys on that one. This was a large pullback. Granted, they paired the losses off the lows here. Great bounce off the lows with the NASDAQ closing down about 51, but it was still a sizable sell-off. And now all of a sudden, we still favor the upside somewhat, but you want to continue to watch for the key levels, all right? All right, we want to basically follow this low right here. All right, the lows from January, which match up right across here. If we want to draw that line all the way across, you basically see how that's the lows in January. We have to really watch that level, because if that level gets taken out to the downside, it could yield more downside in this market. So that's the level you have to watch on the downside. Should we get below that, you got to be on high alert for a negative move in the markets. Now, as long as we stay above here, we slightly favor the upside. Now, you might say, well, why? We had a big down day today. Well, believe it or not, for the week, we were still up. The markets were still up for the week. So you had that mega 80-plus point move on the NASDAQ. Then you had a pause day where it was down 10. Then you had the 20-point move up on the NASDAQ. And then you had the 50 down on the NASDAQ today. That's just recapping the last 4 days or so. So my point still being is that the markets were still up for the week, even though it was still definitely a rough week. And you have to take that as a grain of salt, is that it was a powerful down move today. And we have to really start watching this level. This is everything right here, guys. The January lows, we break below these January lows. That's everything. So keep a close eye on that. On the upside, we've been on a volatile. Look at the moves in this market. From the low here to the high here to the low of that day where we gapped down and then rallied all the way up here to the day here, it has just been an insane week. And frankly, I'm exhausted. I mean, you try to trade this market intraday, these moves, and call it out in the chat room like we do in the E-mini and the day trading chat, which are combined in a phenomenal product, by the way, folks, and service. But just an exhausting maneuver. I mean, I heard about traders getting clobbered today. We kept everyone relatively safe today, which is great. You know, in a day like this, as a trader, you have to understand that they're out there to whipsaw you and take your money. I mean, that's the way the market is. Look at Bear Stearns. I mean, I heard about traders trading Bear Stearns and just getting clobbered. Traders were buying here, buying here, buying here, and it would just keep on falling. Virtually, Bear Stearns went from $57, which is what it closed at yesterday, to $63. So it was up $6 or 10% pre-market right away on the news, and then reversed from $63 all the way down to 26 and change. Think about the volatility, and think about people trying to bottom fish and catch the falling knife. You catch it even when it's at $40 or $35 or even $30, and ultimately it goes to 26. You cover for a loss. I mean, people got their head handed to them today. And luckily, we keep people safe in that chat room, and that's all we can do. We try to maneuver the markets, get some good trades out there, and keep people from getting killed in markets like this, because this is the market where it bankrupts traders. This is the type of market that people look at the volatility and say, wow, it's a great trading market. I, as a trader, will tell you from years and years of experience, this is one of the toughest markets you'll ever trade, and you should probably sit out this market and wait for the markets to calm down. So it's just a matter of the way you look at it and the experience you have. Experienced traders will tell you this is the worst, this is the toughest market to trade in. You trade in this market and do okay, you'll be a lifelong trader and be a millionaire in no time at all. All right, so be very, very careful, folks. Continue to watch those key levels. Looking at the NASDAQ, you can see the NASDAQ is very close to closing below this low here, and this is the next area we got to watch on the NASDAQ, all right? So watch the low from last week on the NASDAQ. Have a wonderful weekend, guys. Be safe, and we'll see you all on Monday. Come join the chat room. Take care.